Hi everyone, good morning and welcome to today's webinar. We're so excited to dive into the story and strategy behind the Bank of India Mid Cap Fund, a fund that's been making waves for its consistent long term performance and sharp mid cap focus. We're honored to be joined by Mr. Alok Singh, who is the Chief Investment Officer at BOI, Bank of India Investment Managers. He is a CFA and a postgraduate in business administration from ICFAI Business School with over 24 years of experience in fund management for both domestic and global investors. Since joining BOI Investment Managers in 2012, he's been instrumental in growing the firm's AUM from 100 crores to nearly 12,000 crores. That's truly an incredible achievement, sir. He currently heads the firm's equity and fixed income investment operations and has received numerous uh, accolades for stellar fund performance over the years. Over to you, sir.
Thank you, Neha, and uh, good morning, everyone. Uh, what I'll do is, I have a small presentation to talk about the NFO, and I'll run you guys through that. And subsequent, I think we will have time for Q&A.
Sure. Yeah, sounds perfect.
Okay. So, as we all know that, mid cap is a known category. It is not an unknown, and it's been existing for a long period of time. It is just that we didn't had this in our product offering, uh, and we wanted to fill this gap now. And so, basically, what we have done is we have broken down the presentation into. Yeah. So I've broken down the presentation into three part. One is when we talk about the mid cap as a fund and why should you be looking at now, especially because there are a lot of noise around the valuation and things like that. And lastly, why Bank of India mid cap fund. So if you look at the markets, see, markets are always reflection of what's happening in the economy. So if you look at the chart in front of you, we have seen in last 10 years, our economy has grown from $2 trillion to $4 trillion, which is roughly 2x. As a result, if you see the chart on the right hand side, the markets have done 3x. So markets always tend to do more than the economy because of the reason that the markets are forward looking. So, the 2x of this 3x is coming from the cash flows which got generated over last 10 years. And then there is a forward looking statement because we are talking of economy becoming $6-7 trillion in next 5 years at least. So that is what the basically the market trajectory. But if you look at from the point of view that last 4-5 years, while the large cap has done 3.5x, the Nifty mid cap index, which is the next 150 stocks, they have done 4x. Now, obviously, when we talk of last 4-5 years, the post-COVID normalization is something what people, mention, and then obviously they say that that was an abnormal year for somebody to be considering it for extrapolating or taking a cue from that, right? However, if one look at the long-term data, this is the last 20 years data for the mid cap, large cap, and small cap. Clearly, there is a visibility that the mid cap has outperformed the large cap and the small cap, right? Even if we look at the global scenario, this is the US thing where you can see that the mid cap has outperformed um, uh, the large cap over last 35 years, right? So it is not 1 year or 2 year phenomena. Yes, the last 5 years were good because of the COVID disruption. But if you look at from the long-term perspective, also they have done quite well. So the question comes is that what happens in the mid cap scenario that uh, the companies or the indices do such better performance compared to other categories, especially large and small. So if you look at this chart in front of you, and if you look at when the companies are small, typically they have lesser number of clients, so the client concentration is higher. And to increase their business, typically they like to compromise on the what you call the they compromise on the margins part, right? Uh, but as they become slightly bigger, you see that the uh, number of clients increases, and the operating efficiency comes because they have become bigger. Combination of that, the cash flow improves, and that improved cash flow attracts more people, right? As a result, the multiple also expands. So in the mid cap phase is a phase where the profitability of the company increases, cash flow improves, and that attracts more people. As a result, the PE multiple also expands, right? And that's what generates superlative return for the corporates and the index altogether, right? Now, if we look at one more thing which happens for this is, as I was saying, that the number of people get attracted, that can be seen by the number of brokerage which get covered, the number of analysts covering mid cap is more than the small cap. Obviously, it is lesser than that. So mid caps are slightly more discovered, but still not as discovered as large cap, so to say. But this leads to what I was mentioning, the PE re-rating, right? Also at the index level, what happens is that the mid cap has a larger sector coverage, because most of the businesses, they start as small and then they become mid and large. Right. But if you look at, say, for example, we have been talking about Make in India for some time as a country. But if you look at the capital goods exposure, which is the second one in the table, the large cap only has 2.4 versus mid cap having 13.2, right? In the middle, if you say real estate sector, real estate is one place where the large amount of people get involved, large amount of resources get involved, and it is important for any economy per se. Over there, if you look at the representation in the large cap is only zero point 0.6, whereas the mid cap is 3.2, right? So in a way, if you look at um, uh, you know, mid cap has the larger number of sectors, and because they are many of the new sectors, get added, it is typically a high growth. So if you look at some of the sectors like asset management, general insurance, health insurance, these are all high growth sectors, right, in the today's financial markets. Uh, these are barely have representation in the large cap, right? So I think that is what combination of it leads to they performing well. Obviously, when they perform well, they also come with their share of volatility, because they are, you know, uh, discovered but not as discovered businesses are stable but not completely stable, right? So if you look at the chart on the right hand side for the 3-year period, the large cap standard deviation is 4.8 versus the mid cap, which is 9.4. But if you stay with them for a longer period of time, not only that risk profile comes down, but also the gap between the large and the mid also comes down, as can be seen on the chart. Now, if you look at that risk profile married with the better return profile on the left hand side, I think that offers a good risk return matrix, and that's why one should consider this as a category, and it should be part of any investor's portfolio. Obviously, the proportion of that is driven by the risk profile, but mid cap as a category has a case to be part of anybody's portfolio. But in fact, if you look at all the three categories put together, so right hand side, obviously, the as the wisdom will say that the large cap is the least volatile, followed by mid cap, and then the last one is the small cap. So that the volatility on the right hand side is in that order. But if you look at the return profile of the mid cap index, is far better than the large cap and the small cap. Now, this is what we are talking of index, and the individual funds may have done better because the alpha generation by the individual fund manager may be different. But this is just to represent the risk profile and the return profile of the individual category, and that's why we are using only the index. So in that also, if you look at the mid cap you don't have to take the highest amount of risk to generate the highest amount of return, right? So it again reiterates the point which I've been mentioning, that on the risk adjusted basis, yes, they are volatile, but on the risk adjusted basis, they offers a good return profile provided you continue to hold them for a 5 to 10 year horizon, right? And if you look at on the 5 to 10 year horizon, then on the rolling return basis, the top chart is the 5-year rolling return, and the bottom is the 10-year rolling return, right? So if you look at, they've been able to outperform the large cap by 15 to 20%. So, that's what and if you look at the chart, clearly indicates that they have been able to outperform for a longer period of time. Right? Because on the 10-year point, the first point is actually data from 2005, right? 2005 to 15, because it's a rolling return. So, it's a 25-year data, which clearly say that they have been able to outperform handsomely, right? Now, then the question comes is that if they are a good asset class, and everyone will agree with that, and especially last 5 years have been fantastic, and that has made them expensive. If you look at the chart in front of you, while they have generated better return than the large cap, as a result, the ratio over the large cap to mid cap ratio has moved from 3.9 to 2.4. Right. So obviously that with that backdrop of performance, why one should look at now, and what makes the things attractive, and why should you look at it, right? So obviously, if you look on the left-hand side of the chart, this is a slightly old data when the presentation was made, but more or less it is still relevant. The Nifty 100, which is the large cap, the trailing P, 12 months trailing P of that is 23. Right. Of the mid cap index, it is 34.5, right? So clearly, mid-cap PE multiples are on the higher side, right? But having said that, if you look at, you always like to pay premium to something which is offering you a higher growth. So higher PE, anybody is ready to accept, provided that is offering a higher growth rate, right? So if you see between 23 and 34, the gap is roughly 50%, right? So while mid cap offers higher return, higher earnings growth, but the growth differential between the large cap and mid cap is not 50%, right? So obviously that this again make that argument stronger that the mid cap are expensive, right? But if you look at this 23 and you say, okay, what is this 23 getting built from, right? This 23 has a lot of sectors which are low PE sectors. Case in point, all public sector undertaking, oil and gas companies, your metal companies, which most of the investors don't buy. So if you look at any large cap fund portfolio, you will barely find these names, right? So, and that is what is pulling down the index weighted average P to 23, right? So in that context, if you look at the equal weight, because then every stock has a similar weight. So the equal weight large cap index, the 23 becomes 34, right? And 34.5 of mid cap becomes 40, right? So now why this is important? Because as I said that as a fund manager of large cap, I am not buying the stocks which are making the index cheaper, right? So while I'm arguing for large cap versus mid cap, I am looking at 23 and 34. But when it comes to investing, I am not investing at on average 23. I'm investing on average 34, right? And if you look at gap between 34 on 40 on the equal weighted side, the gap is around 18%. Now, this gap can be explained by uh, the gap in the growth rates, right? So this equal weighted index looks more reasonable and comparable. But then obviously neither 34 is cheap nor 40 is cheap, right? So my main point to this slide, or rather what I wanted to emphasize on that the market is overall expensive. It is not that only mid cap is expensive and everything is okay. I think the if you look at from this lens, both large cap is expensive and the mid cap is also expensive. Then but at the same time, we also believe that the markets will remain expensive, right? Because if you look at this, expensiveness is coming from the re-rating which India has gone through, right? As an economy, because we are more stabler economy, and also we are the best growth in terms of the growth parameters, right? And also the return ratio. So all the three parameters are fulfilling, and as a result, we may remain expensive for a longer period of time, right? Case in point, you can relate to it. Even, 20 years back when HDFC Bank got discovered by the market, it was one of the most stable bank with higher growth potential and return ratios. As a result, it became the most expensive bank in the world in terms of the price to book multiples, and it remained expensive for next 15 years. So once the thing has become expensive, it does not mean that it has to become cheap immediately, right? It can continue to remain expensive for a longer period of time. So basically, in the last 5 years, India has been re-rated. Once re-rated does not mean it has to be derated immediately. And this is where the expensiveness is coming. And we believe that this expensiveness can continue for some time. And that some time is till the time India does not falters on growth and is the stability parameters, which we don't see is happening anytime soon. So I think that's where, market, you should look at it that, the P ratings for the markets is not going. So basically the entire return profile is going to come by the earnings growth translating into the price performance. So, which means that these very high superlative returns of 40-50%, which we made in last few years, I think that is what you can expect. But a reasonable return, which is somewhere close to your long-term averages, I think that is what is a more reasonable thing to look at. Also, that confidence comes from the fact that in the recent, this what you have now is the forward 12-month PE. So last year there was the mid cap, which is on the left hand side, was trading at 34, 35 forward PE versus the long term average of around 22. Right, this is a 10-year average we have taken, not very long, because this is the point where India was a larger economy, 2 trillion in 2015 and now 4 trillion, right? So the numbers are comparable. Versus if you look at large cap on the right hand side, it was an average 18, which is trading around 20. So in last 3-6 months, especially January, February correction, the mid cap has given away a lot of excesses, right? So they are much closer to their long-term average, and that's where I think it offers a reasonable entry point from here on, and to expect a reasonable return from here. That's why, we think that it is a good time to look at the mid cap as a category, right? Also, if you look at the recent underperformance of mid cap, can also be seen from this lens. If you look at the last line, which is 2025 YTD, the mid cap has been underperforming the large cap. But if you look at the data above, mid cap underperformance versus large cap has not stayed for a long period of time. And every time the mid cap has underperformed, it has been married by a very strong outperformance by the mid cap, right? So we have not concluded our calendar year. We still have 5 months to go. I really don't know whether this red bar will remain a red bar or will be a green bar, but whatever it is, and we are seeing a stage of underperformance. And if the history has to resonate, clearly means that the underperformance should not last for a longer period of time, right? Uh, so that with that, I think it makes a sense that one should look at mid cap as a category, and I think right now is a reasonable time to look at it. Yes, it optically appears expensive, but then it is not only one corner which is mid cap. It is expensive. I think the market itself it is, and that's where we are saying that it will remain expensive if we don't see a correction, so to say. Then, obviously from the point of view that why one should look at us as a fund house, and especially the mid cap. Obviously, our we don't have a full scale mid cap fund, and which is under offering right now. But there are funds which have larger mid cap exposure, and over the period of time, if you look at, they have done quite well. That gives us a confidence that we should be able to manage a full scale mid cap fund very efficiently. In fact, overall AUM, as we speak, we are around 13,500 crores in AUM, out of which 10,500 is equity. Out of that 10.5 equity, roughly 60% is mid and small cap. So we have our experience in managing, and we have a good 5-10 years track record in some of the funds and have done quite well. So, and that has been possible primarily because of the investment process which we have been running, which is primarily, when you look at any business, you try to do the filtration, which is called the hygiene check. Look at the business, look at the management, look at the financials, which is everyone is doing, right? And this portion may be coming from the fact that the approach can be bottoms up or the top down. So point number 1 and 2, basically that is the identification of a stock, right? But I think we differentiate ourselves because we are not focusing only on identification, but we are also focusing on the point number 3, which is the risk management. And when we say risk management, it is not that we are avoiding risk or reducing risk. We want to take the right amount of risk because we are in the business of taking risk. If we take right amount of risk is when the schemes will perform, right? So you have identified the stock, fine, but what you do with that stock, how much you allocate, what's the trade size, right? Those plays an important role, and for that you need to have answers. Like, why are you owning this stock? What do you expect it to do, right? So when we do it, and that is what part of our risk framework. And if you look at when we say that, okay, what is that you are expecting? So you expect it to behave like a compounder or a challenger or a turnaround, or it has fallen so much, now it is intrinsic value. So that is what, if you look at the 6 parameters, which is what we are not badging anybody for life, right? That, okay, a company is a compounder. We are saying, okay, we have identified Now, this is what is going to change in the business. And this change will be more like your compounder, right? Or this change will be more like a turnaround, right? So because then when you identify and batch that, you are able to then do the risk allocation right way, right? So if it is a turnaround case, obviously there is a risk which is higher, because if that particular event does not happen, then it may have an impact on the outcome of what you are expecting, right? So in that case, you will not like to take a large position. But if you are expecting that something to be a normal compounder for that period, maybe you can take a larger. So that's how, the allocation works. And that is where we have laid a lot of emphasis. And that has allowed us to perform over the period of time. And I think there where we are able to distinguish, and we will be able to, we feel confident that we will be able to do justice with this category also. This fund will be managed by me directly. Uh, this fund, ideally, you should look at 5 years plus for this category, but it should be part of everybody's portfolio. As this category is a core category. When we say core category, then a larger portion of the money should be deployed. So large cap, mid cap, small cap, the plain vanilla are core categories. So whenever you look at any core category, there are two things which is important: that the fund should be true to label, and fund should be efficient. I think that is what we are trying to achieve, so that people get the exposure what they want, and they get the the desired outcome from that. Index for this fund will be Nifty 150 index. There is a load period of 60 days for 1%, and after that there is no load period. In terms of asset allocation, there are 65% minimum has to be in the mid cap. The balance 35 can be in large cap, mid cap, small cap, or debt, or up to whatever situation is prevailing at that point in time. And fund can also invest in REITs and InvITs up to 10%. So with this, I think I'm done with my presentation. I can take questions. I think you're on mute. You have to unmute yourself.
Sorry, my bad. Uh, so the presentation highlights multiple growth leaps over the years, right? But can you walk us through this leap strategy and how it reflects in your, portfolio approach?
Sorry, come again. I didn't. Can you raise the question again?
Yeah, can you just walk us through your strategy, your multiple growth leaps over the years, right? Can you walk us
Hmm.
through your strategy and how it, reflects on your portfolio approach?
So, see, first of all, as I mentioned that for any business to do well, the economic conditions should be supportive of that.
Yeah.
If the economic conditions are not supportive, that does not. So that is the primary thing which you should look at, right? So, and that also allows you to have, that factors in what how aggressive portfolio you want to build, and how conservative portfolio you build, right? So that's where it is all part of the risk management, as I was mentioning, which we are trying to practice more efficiently, because there are no, obviously there's a science and an art which is there. But one thing which is the center of our starting point is that whenever we are buying any business, right? Say, for example, if my fund is having a benchmark of, say, BSC 500, right? And the ROEs of that BSC 500 is roughly 16, right? So if I'm buying any business, then I should be buying a business with a ROE better than 15. Only then in the medium to long term, I will be able to outperform, right? Uh, but for that, I should be paying the right price also, which is not always possible. So then if you're buying a lower ROE business, then in that case, there should be something happening for that ROEs to change. So if you're buying 10, then ROE should move to 15, and then you should be confident whatever it is happening. So that is where, we are toggling in that, why you are buying this, and what do you expect from it, how the change will happen. And so our investment strategy is knitted around all of these questions. There are some tools which we use to get the answers and get some amount of predictability. And then the last is the allocation. As I said, that all depend on the economic conditions and all that. That is what we have been able to shift as the things move on. And that has helped us over the period of time. Like case in point, if you look at, some of our funds, like if you look at this mid and small cap equity debt fund, right? This is a 9-year-old fund, right? It is a hybrid fund with, maximum 80% equity and 20% debt. I think it has a CAGR of around 17%. I think it is quite decent. The mid cap fund, the multi cap fund is a 3-year-old fund, and I think it has done quite well there also. So I think with that thought process, we have been able to demonstrate the outcome which is of outperformance over various period of time. Right. And if you look at in last 9, 10 years, there have been various bouts of volatility. They will continue to be there, but I think we are equipped. So, precisely saying where, how we have navigated obviously is a function of our, the only parameter to look at it is how our historically our funds have done. But yes, what I said is in terms of our process, I think is a center theme of it.
Okay. So one of your slide shows, right, the mid cap funds have outperformed large caps. Mid caps have
Yes.
outperformed large caps in 12 of the last 20 years, right? What do you think makes this trend sustainable? And what are some of the things that investors should expect moving forward?
So if you look at, as I said, that see, first of all, mid cap as a category has outperformed because of the two reasons. One is the growth rates are faster because typically they are not very big companies, right? So they obviously with a lower base, the growth rate is faster, and that's what the markets typically appreciate. The rate of change is higher. Right. Second is also that the margin profile improves, right? Because as you become bigger, you all know the bigger companies start enjoying the operating efficiencies, right? The number of clients becomes more, right? So what you're seeing a higher growth rate married with higher profitability. So your cash flow quality and quantity both improves. That gets, that's like a honey to the market, right? And everyone gets attracted towards it. And you start then chasing that and the multiples improve, right? So your cash flows improves, profitability has improved, your multiples have improved, and that is where the outperformance comes, right? And that's, but at the same time, as we showed, that the volatility is higher, right? But because and whenever the volatility hits, obviously they underperform. So all the red bars, if you see on the chart, are the periods where the volatility has been higher. But because once the things get stabilized, people cannot ignore the high growth rate. So they get attracted with that again. So as a result, the bounce backs also happens equally fast, right? So obviously you can't kill that volatility other than the time period. So if you stay invested for 5, 10 years, that volatility comes down substantially, right? And even if you get caught on the top side of any of these, the and you stay invested for a long period of time, your probability of making decent money is still very high.
Right. Okay. So, who do you think is the ideal investor, right, for this fund? Do you think it should sit in the core or the satellite portion of one's portfolio? What do you
This is
think?
very much a core strategy because it's a plain vanilla mid cap fund, right? So it's a very much a core strategy, and core allocation should be part of everybody's portfolio, whichever risk profile person is. Obviously, the proportion of that can vary from person to person, which the advisor or the person himself have to think through what is the right allocation. Also, when we look at any core allocation product, we also expect it to be true to label, right? So as an advisor, if you want an exposure in the client's book for X kind and the underlying fund is not giving the right exposure, then there's a problem, right? So it has to be true to label, and that's what our promise is, that we will be true to label, right? And obviously, when you are allocating larger portion of your money, because being a core category, you want it to be efficient. So, we believe that our investment process is geared enough to deliver efficient outcome of that.
Okay. What do you think investors should know about liquidity, exit load, or tax implications while they invest in this fund?
So liquidity, obviously, this is all T plus one liquidity. Only for first 60 days of investment, from the day of investment, first 60 days, it attracts 1% load. Post 60 days, there is no. It is not that in the exit load period also one can invest, redeem. It's not that. So liquidity is there. Only thing is first 60 days, the cost of liquidity is 1%, and then subsequently there is nil, right? And I think what was the other point you want to mention? Liquidity and
Yeah, liquidity, exit load, and tax implications.
so tax is an equity fund. 65% has to be at least in equity, or so it will continue to enjoy the equity taxation of both short term and long term.
Mhm. Okay. So, given how volatile mid caps can be, is SIP a more effective route than lump sum for today's investors?
So I think the time spent is more important, right? Because SIP also is a function of you may not have all the money today, right? And that's why, you are investing as in when you are getting money, right? But if you look at the answer lies in the right-hand side of the screen. So if you stay for a longer period of time, right? So whether you're coming as a lump sum or SIP, you still have to stay for a longer period of time, right? And that is where if you see the risk profiles drops quite drastically, and also the absolute number comes down. So I think whether you come through an SIP or you come through a lump sum, the principle is that you have to stay invested for at least 5, 7, ideally 10 years.
Okay. Okay. So, those are all the questions I had from my end, sir. Would you like to add anything else?
So, I think as a part of my concluding remarks, I would like to say that, while there is a lot of noise regarding valuation, that is all because of the PE multiples, right? And we strongly believe that that's primarily because of the India's re-rating, and once something get re-rated, it does not get derated immediately, right? So that makes us believe that we are not going to uh, become cheap anytime soon, and one should look at that way, that you have to buy things expensive and you maybe have to sell things expensive. That does not mean that the markets are going to correct tomorrow. And as it is, if you look at last 1 year, the markets have been consolidating. We had a round of nervousness in January, February, but the markets have rebounded quite swiftly, digesting all the wall of worries, right, which was coming right from the latest one has been the tariff thing. We know we are sitting on the worst case scenario now, right? And despite that, the markets are quite stable. So I think that should give strength to the people, that the quality of the cash flows which Indian corporates are generating is quite healthy, and that should protect the market. And one should then look at the journey of India from $4 trillion to 7, $8 trillion, right, in times to come. And that itself is, if you look at, is a fantastic CAGR, right? And, as I started with the slide, I will, put back the same slide. If you look at the economic growth, will certainly get reflected in the market capitalization. So from $4 trillion, even if you go to $6, $7 trillion, that's a fantastic CAGR. And while it may not be one-to-one reflection into market caps, but certainly markets cannot ignore that.
Yeah. Fair. Okay. So, to conclude the webinar and to end it, thank you so, so much, sir, for taking the time to walk us through the strategy, performance, and vision behind the BOI Midcap Fund. Your deep insights into, midcap investing, risk management, and long-term portfolio construction gave our audience a clear and practical understanding of the opportunity this fund presents, right? And to everyone who joined us today, thank you so much for being a part of this conversation. We hope this session helped you gain clarity and confidence in navigating the mid cap space, right? We look forward to seeing you again in our upcoming webinars. Until then, happy investing and stay consistent.
Thank you.
Thank you.
Thank you very much.